Hey folks, I'm hearing through the grapevine that the Smartboard notebook lesson that we did today is not appearing on the Google Classroom. And I swore I'd never make a video like this in a car that you see on Instagram. I thought it looked really stupid, but here we go. So, the things we covered today that would be helpful reminders before tomorrow's exam would be: number one, College Board likes to teach students that government interference with tariffs, quotas, price ceilings, and floors is bad for the economy. It creates what we call allocative inefficiency or a dead weight loss, and that results in things like surpluses and shortages when we look at ceilings and floors. Let's remember, a price ceiling is drawn below equilibrium and a price floor is drawn above equilibrium, which is a little bit counterintuitive. The next thing I want to focus on is bond pricing. We know that bond pricing is inverse to interest rates. So if there's a question where the Federal Reserve buys bonds, which lowers rates, that's going to make bond prices go higher. Next, we talked a lot about the Keynesian model. Although you won't have to graph it, let's understand that below full employment, it turns horizontal, meaning that prices and wages get sticky. So the classical model shows more of a vertical supply curve. This would be more of a horizontal one. Why is that? Well, as Professor Robbie Glusker points out, when that happens, meaning we go below full employment, workers may not accept lower wages, and businesses may not be willing to sell their products and services for lower prices. So the Say's law notion that the market will automatically clear is refuted because John Maynard Keynes believes things like unions and 20th century company perspectives don't always make prices and wages freely floating, and therefore we may have gluts. And it's not the market will clear, supply creates its own demand. And that runs counter with classical theory, where the economy will fix itself because of this notion that things are flexible and it's a self-correcting mechanism. Next, we talked about the Phillips curve, and it's important to note that the long-run Phillips curve is a vertical line, and it intersects a curved line that is actually bowed in, as opposed to the PPC, which is, as we know, bowed out. We have inflation on the y-axis and unemployment on the x-axis. The key thing we focused on today was what shifts a point on the Phillips curve and what shifts the whole curve. Aggregate demand shifters like tax cuts, government spending increases or decreases would be a point shift on the Phillips curve, up or down, based on whichever the government action in this case would cause. And then aggregate supply shifters like inflationary expectations or negative supply shocks with oil, that would shift the whole curve. And let's remember, this is the only curve where a shift to the right is bad, because that would cause an increase in unemployment and an increase in inflation. College Board sometimes will tell you where to plot points on the Phillips curve, 3%, 4%, etc. And that would dictate, Professor Thomas Cox, where we do draw the long-run Phillips curve. Back to the PPC. We know that a point inside of it shows we're not utilizing our resources properly. We know that a point outside the curve is currently unattainable, but it can be attained with economic growth. Economic growth can be brought about by things like improvements in technology, human capital, more abundant resources, better resources. And it's important to note that the PPC does reflect the LRAS on the aggregate supply aggregate demand model. And that when that shifts to the right, so will the PPC. And when that shifts to the left, we see the PPC going inside its curve. All right, other items that came up today within our little review session. As one angel pointed out, we must be aware of several items. First and foremost, we know that when price level goes up and GDP goes up, there will be more demand for money. So MD on the money market model would shift to the right if consumers need more money to buy goods because GDP or price level's gone up. The other shifters of MD would include speculative and precautionary demand. And you can look that up falling under the umbrella of asset demand. Let's also not forget about the current versus the financial account, formerly the capital account. And the flow of goods across borders, that would fall under the current account, whereas assets that you can't bring across borders, like real estate, would fall under the financial account. Let's also remember, when you get stuck, AD or GDP equals C plus I plus G plus net exports. The loanable funds market is affected by several different entities, including monetary policy. So if the Fed buys bonds, that's going to increase the supply of loanable funds. Fiscal policy, obviously crowding in and crowding out, is reflected by fiscal moves to deficit spending, which would cause, in this case, a demand for loanable funds and higher interest rates, which crowds out private investment. Speaking of private investment, let's not confuse the fact that investment is businesses buying capital goods such as buildings, machinery, tools, and equipment, whereas foreign investment reflects foreigners chasing our higher bond yields. And that would impact the loanable funds market and increase our supply of loanable funds. Foreigners doing that, by the way, would also impact the value of our currency and therefore increasing and decreasing exports. For example, if the interest rates in the United States are going up, let's say the Fed raises rates to deal with inflation, then foreigners might buy our bonds. They would have to go to the foreign exchange market, and that might be Jonas Baerger's booth or David Eritrea's booth. And to do that, they would demand the US dollar, which would make it appreciate or get stronger, which would increase our imports, but we would export less because it would be comparatively more expensive now for foreigners. That's 8 minutes worth of last minute review. I want to encourage you to eat a good meal tonight, whether that's a Sophia Frixell lasagna, a Jacob Alperin gigantic sandwich, or just some basil mathai spices. I would also encourage you to get your sleep. And if you haven't done so already, maybe go for a brisk walk to get some oxygen in the system. I'm going to rock out right now, but I want to remind you that New Rochelle rules, and I want to wish you all luck tomorrow. So, best of luck, have fun, and let's do this, folks.